Good morning, everyone. This is Sam here again from NATP. I have with me today Sheri Fronsee. Sheri is a tax content specialist with us at NATP. Sheri is keeping an eye on everything that is going on in the tax world, or as much as she has time to anyway, with between her other job duties. But Sheri is here to talk to us today about some of the biggest stories that we've been following that you probably maybe have been following or maybe have been heads down in returns and you haven't been able to keep up on the latest news. So Sheri is here today to help us out and get updated. Sheri, thanks for being here. I hope everything is well in your corner.
Oh, absolutely. And thanks for inviting me, Sam. It's always fun to do these.
Absolutely. So before we start, Sheri, let's can you tell us a little bit about yourself, current position at NATP, background, anything else you want to share?
It's really kind of boring. Currently, I am part of the tax content team. I used to be a researcher, still dabble in research, and it's a hoot, always talking with our members. That was always my favorite part of the job. But now I focus more on writing, and I do some occasional instructing, which is awesome. And every once in a while, marketing wrangles me into doing these things. So they're all fun. And I just basically love what I do. So you're stuck with me for a while.
Well, we are more than happy with that. So Sheri, if it's all right with you, I'm just kind of going to let you take it away and tell everyone about the latest news stories. We've got 4 topics that we're covering. And so I'll just let you take it away.
Okay, I will, I am one of these kind of people that just take over things, I guess. So, what I wanted to do today, gang, is, we're in our little corner of the tax world right now. And we have that 2023 filing season looming just around the corner. And we need to start thinking tax returns. So I'm not giving you any real earth-shattering news like Sam may have been implying. I'm kind of bringing this down to the practical level, what we need to know coming up in January, okay? And the best place to start with this is I want to show you the draft 2022 forms. If you haven't had a chance to look at them, I think we might want to take a little peek at them right now, okay? Hopefully you can see the slide presentation or just a few slides that I have right now. What I'm going to do, the next 2 slides, 2021 is on the left side, 2022 is on the right side. And I've tried to circle things to help draw our attention to them. What I want to show you is this draft 2022 form. This is the latest draft from right around September 1st, okay? I want to mention a few of the changes that are going to be happening on this one. If you look at the very top line where we have our filing statuses, the last one, qualifying widow or widower is what it used to be called. Now they're looking, and then they kind of were switching up to surviving spouse. It would be SS, QW, whatever. Well, we've compromised. It looks like it's going to be qualifying surviving spouse or QSS going forward. So that's just something of interest that I wanted to point out. So be aware that there could be a terminology change coming out. If you slide down the form a little more over to the left, you see I circled something where that virtual currency question is. Well, it's not exactly a virtual currency question anymore. It's now called digital assets. All right. I think that's encompassing the NFTs in there too. All right. So our question in this line, it's changing again. For 2022, it's going to read, at any time during 2022, did you A, receive as a reward, award, a payment for property or services, or B, sell, exchange, gift, or otherwise dispose of a digital asset or a financial interest in a digital asset? Check, yes or no. The question's getting long and it's getting more and more specific. As a reminder, activity in the digital asset world, gang, that could very well be either ordinary income or capital gain income to taxpayers, and we need to watch it. And also keep in mind, broker statements are going to start showing this, or I should say digital asset broker statements, they're going to start coming out. I don't know a lot about the format they're going to be coming out in yet, only because maybe I'm not that smart yet, but that's okay. But keep your eye out. I know many of the digital platforms had them out last year, or a lot of statements, because I saw them, I should say, when I was filling out tax returns last year. I just don't remember off the top of my head which ones were the ones that were doing them the most. All right. But I'm sure you saw some last year. You're going to start seeing them more and more because they are becoming mandatory. All right. So that's enough with the digital or virtual currency, digital assets or virtual currency. The big one I want to show you is line one. This is huge. All right. Line one, we just had line one, earned income, right on the W-2 wages. And then you put on the little dotted line, like DCB for dependent care benefits that were taxable or whatever else it was, like SCH for scholarship. Well, if you look at, they added a ton of lines to this. Remember, we would have, like I said, that DCB, you just put it over there, that would roll over from the 2441, and then you would just drop the little initials on that line. Well, no longer. If you notice, line 1A, that is going to be just for our W-2 wages. 1B, that is going to be for household employee wages. That's where you're going to have your Schedule H's, and you could potentially be issuing W-2s to your household employees, and that's going to be reported on a W-2. All right. Then you could have on line C, that would be your tip income not reported on line 1A, or that was not part of the regular wages. Then you have the Medicare waiver payments not reported on a W-2. That's going to be on line 1D. Line 1E, that is going to be your taxable dependent care benefits. Remember our former DCB on that line. Then line 1F, that is going to be your employer provided adoption benefits that are often taxable, or, in certain circumstances, they could be taxable. Then on line 1G, this is going to be wages from Form 8919, which is your uncollected Social Security and Medicare tax on wages. And then line 1H, that's other earned income. And then line 1I, non-taxable combat pay election. Those are the ones that we have isolated out right now. But as you can see, there's a lot of room to grow. But I don't know if you noticed what was missing in that list that I was reading, because the first time I went through it, I said, seriously, where'd it go? Scholarships, folks. We had the SCH up there. That is now reported on Schedule 1, line 8R. Schedule 1 has expanded their line 8s to include more like this is going to be 1R. I think it's going through T now. I'm not going to address Schedule 1 here because that's all they really did to it, was add a few more lines. But the big one is the scholarships. That's no longer part of the wages on line 1. That now goes to Schedule 1, line 8R. And I would run into that periodically doing taxes each year. Just, I don't know about you, but just be aware of that, where that moved to. Also, you're above the line charitable deductions that we had in 2020 and 2021, gone back on the Schedule A right now. That was only a 2021 thing. That was, you can see on the 2021 form, you had standard deduction on 12A, and then on 12B, you would have the charitable deductions. On the 2022 form, it's just standard deductions now. Like I said, back to the Schedule A. And then we want to look at on page 2. This is pretty simple. All they did was take lines 16 through 33 and just break them out into credits and tax and then the payments. It's so much neater now and cleaner and easier to see and read. Okay. I hope you like that change too. So far, I think all the changes are pretty awesome. It's helping us really identify and getting specific with what we're reporting. I just think it's all very helpful to us. Okay. But we've gone from our short little postcard kind of forms. They're getting kind of long again. But anyway, that's okay. Now, I want you to look at line 27. Last year for the earned income tax credit, we had it broken down into like A, B, and C. Well, in 2021, we had some unusual things going around for a few items, earned income tax credit being one of them. Well, that's all reset back to normal. So for 2022, it's just line 27 for earned income tax credit. Then the next line I want to slide down to is line 28. Last year, it said advanced child tax credit. This year, it's reset back to additional child tax credit. Line 30 on the 20 and 21 returns, that will say recovery rebate credit. On 22, it is now stated reserved for future use, and you can see it's even grayed out. All right. Now, these are the big changes to the 2022 proposed or draft 1040 that I wanted to mention to you. That they're going to be the ones that we're going to stumble into the most. It's just the line 1 that was huge, and I just wanted to make sure you were aware of all the breaking down. A lot of people are kind of debating, why is it broken down, or why are we getting more broken down with all these different categories? I was chatting with my boss the other day, and his philosophy is, which I agree with, all these items, once you put them on these separate lines, they're going to become easier to match to other forms or W-2s or something of that nature. So we kind of suspect it's an effort for improving the IRS matching program. I don't know if it's going to be successful or not, but I give them kudos for giving it a good old college try to help simplify everybody's life a little bit. All right. Now, that is our 1040, pages 1 and 2. Also, I want to mention to you, if you ever want to see what the draft forms look like, you can go to www.irs.gov/draft-tax-forms. That's where you get all the draft forms and you can see what's going on. All right. They're going to be final if you go into the IRS, just the normal IRS website, and type in the form, like say 1040. And if it pops up 2021, which it was still doing this morning, 2022 isn't final. It'll be final once it hits in there. And under the draft forms, it'll also say a date when it was finalized. Okay. Just little tidbits there. Now, the next thing I want to discuss is our ever popular Inflation Reduction Act of 2022. Now, this IRA, as it's called, kind of confuses me a little bit, but it's the Inflation Reduction Act. They have several provisions, and many have been discussed in our Tax Pro Weekly and such, and just in other publications that have put out. But what I want to do is mention the ones you are most likely to stumble into this tax season, all right? Now, the first one is for the cars. Prior to the Inflation Reduction Act, taxpayers, they could claim a credit for each new qualified plug-in motor vehicle of $7,500. Okay, that was really cool. Now, this was for tax years prior to 2023. This credit phased out when the manufacturers sold 200,000 or more of those particular vehicles. We all know that, had to check online. Are they sold out? Can we still take it? And we would go through all these exercises, right? Well, the Inflation Reduction Act, that renamed this credit to the Clean Vehicle Credit, and it eliminated the number of vehicles that needed to be sold. So that $200,000, that's off the table now. So that's pretty cool. That's a big help for us. Now, this credit, it can be up to $7,500. But to qualify, here's the big kicker. The qualified vehicle, that must have its final assembly in North America, okay? And then it needs to meet some other specifications like battery capacity, things of that nature. And for SUVs and trucks, their manufacturer suggested retail price that cannot exceed $80,000, and for other vehicles, it's $55,000. Now, there's a list of eligible vehicles, and that is available at the U.S. Department of Energy website. And I don't believe I have that website on the screen for you. Sorry about that. And unlike that prior vehicle credit, this one has some modified adjusted gross income limits. Now, it's for married filing joint folks and the qualifying widow or qualifying surviving spouse, whichever we're going to call it. It's going to be $300,000. Head of household, $225,000. All others, $150,000. And also a really interesting tidbit with this is beginning in 2024, the taxpayer can transfer the credit to the dealer. Then the dealer can reduce the purchase price of the vehicle. It's kind of like getting a rebate in a way. It's just kind of redefining it. So I wanted to mention that real quick. Next topic that the Inflation Reduction Act did that I wanted to mention that you could probably run into is, remember the American Rescue Plan Act. That provision allowed taxpayers with household incomes of more than 400% of the federal poverty level to be eligible for purchasing insurance on the marketplace. The Inflation Reduction Act extended that for another year. So more people for this coming tax year are eligible if their income is over the 400% poverty level to get insurance on the marketplace. And this is my favorite one. This is the biggest change that I think happened. Remember that energy efficient credit for homes, if you're doing something for the homes that envelope the homes or just enhanced energy efficiency of the homes? Well, that credit has now been renamed to the Energy Efficient Home Improvement Credit. And it's been extended to include property placed in service before January 1st of 2033, because that was set to fizzle out in the next few years, okay? Now, in addition, the Inflation Reduction Act, it increased the amount of the credit to 30% from 10%. This is all really good stuff, I think. And it's the sum of the amount paid or incurred by the taxpayer for qualified energy improvements installed during the year and the amount of the residential energy property expenditures paid or incurred by the taxpayer during the year. Now, the big change with this is there used to be is the operative phrase there, a lifetime maximum amount of $500. That's like so little, right? You're like, how can anybody do this? Just putting in new windows alone, you've blown that out of the water, right? That has now been replaced with an annual limit of $1,200. This is huge. It's like catching it up with the economy in a way, I would think. All right. So this could be very noticeable for our clients, and we could have a lot of energy improvements coming in. You know, houses get old, you need to replace those storm doors and that. Now, the last thing I want to mention with the Inflation Reduction Act, and we're all going to go, oh, really? You know, that SALT limitation, that state and local income tax limitation of $10,000, $5,000 for married filing separate, set to expire in 2025? No, moved out. It's sticking around until 2026 with us again. Okay, so that was extended out another year. I just wanted to mention that. That one seems to be kind of a nemesis for a lot of people. The next thing we want to talk about is this ever popular topic of the student loans. There's a lot of stuff going on out there in the world, but we're just going to mention a few little tidbits that we know about. First of all, the American Rescue Plan Act, that provided this special rule for discharges of student loans in 2021 to 2025, okay, that the discharge student loan calculation of debt is not includable in gross income, all right? So we had that. Now, the president was out there and he and his group developed this new proposal, right? Where the Department of Education is going to provide up to $20,000 in debt cancellation for Pell Grant recipients with loans held by the Department of Education, and up to $10,000 in debt cancellation for non-Pell Grant recipients, all right? Now, borrowers are eligible for this relief if their individual income is less than $125,000 or $250 for married couples, okay? That's about all I want to say on that, okay? But one other tidbit, to find out more information on this, there is a fact sheet that's out there, and I put the link on the slide. It's really kind of long. Sorry about that. Maybe Sam, I don't know if she has the ability, can post it out there so you can all snag it and copy it if you want. You can go to that fact sheet and read more about this student loan proposal with the $20,000 and the $10,000. Okay, just wanted to mention that. Now, we're coming to a close here. Sorry, I've been taking up a little more time than Sam wanted me to. But the last thing I want to mention, standard mileage. People, we all know we have 101 business clients. They come in with their standard mileage every year. After they pull the mileage amounts off our ceiling tiles, right? You know, we should just be putting the little amount up there. We have to tell them now we need it broken down into how many of those did you drive between January 1 and June 30th and July 1 and December 30th. And please don't tell me it's exactly in half, because that's not going to happen. The IRS changed the mileage rates middle of the year this year. The first half of the year, January 1 to June 30th, it's going to be at 28 cents or 58 and a half cents. And then for the last half of the year, July 1 to December 31st, it's going to be at 62.5 cents a mile. I have a feeling this could be a looked at item this year because the amounts are pretty high and they did go up. I want you to make sure you get mileage logs if at all possible. And if the taxpayer says, yeah, no, I actually drove half and half, just make sure you're in agreement. You can tell by their business it is possible to be half and half and to, have rather consistent mileage throughout the year each month. Totally buy into that. But if they have a business that doesn't substantiate that, raise your eyebrows, go seriously, let's think about this a little bit. Get out the mileage log, all right? Just saying that could be a point of contention this year. And then the last one is, I just wanted to mention, how you can have charitable deduction mileage and medical mileage. Charitable deduction mileage, that stayed at the flat 14 cents. And the medical mileage, though, that one from 18 cents to 22 cents. Again, half, January 1 to June 30th, 18 cents. And then July 1 to December 31st, 22 cents. And gang, on that note, you're done with me for today. I just wanted to mention these fun little tidbits that we have been seeing coming through. Anything else of interest for you, we will definitely have in the Tax Pro Weekly. And just whatever else Sam and Marketing Group decides to send out there to tell you all about.
Yeah. Thanks so much, Sheri, for sharing all this information. It's incredibly beneficial and helpful to know that you guys are keeping your eye on things, and just an update for everyone in general. I know things get busy, and it's nice to get this information. Like Sheri said, this information, we keep members updated throughout the year. In various ways. We've got our Tax Pro Weekly newsletter, which is available to members. Lots of other information, emails, client newsletters, and pretty much everything you could imagine available to members. And so if you're interested in learning more, go to natptax.com/join. Otherwise, that is all that we have planned for you all today. Sheri, thanks again for joining us.
Happy
it's
to
always
help.
a delight to see your face. And anything else you want to add before we depart?
No, just as a reminder. Oh, shameless advertising here, gang. You have to listen to me. Our tax season update, that's alive and well, getting ready to go on the road. If you can attend it live, how awesome is it to reconnect with your colleagues, especially in the area? I just think it's totally awesome that we're able to do it live now, finally again. And then if you do stumble into any questions, don't hesitate to call our research department. They're a really smart group and they can help you out. So I just had to do my shameless plug.
Absolutely. No, that's a great point. And tax season updates, if you're interested in more information, natpupdates.com. Otherwise, we will see you all next time. Sheri, thanks again for joining us, and stay safe and healthy, everyone. Bye-bye.